All right, we're live. As people trickle in, I'll finish the story, Farhan. Just more and more requests from folks with their hair on fire, trying to solve these problems quickly, and asking to get on a call. This afternoon. I tried to reschedule one, and the answer was, "Well, no, I really need to talk about this today." Uh, these problems are important to people, but anyway.
Do you think people are now looking at their tax returns
Yeah,
and
that's right.
thinking, it's a high number, and
Yeah. Or unless you're like me, who helps run a tax company and yet haven't even looked at my taxes yet. It's only March 26th. I've got almost 3 weeks and then a 6-month extension. I've got more important things to do right now, like help clients do this stuff. I feel like the interface changed here. I lost track of. Oh, here it is. The count of visitors. We vamped for a minute. We'll give everybody another minute or two to roll in as we usually do, but also as usual, feel free as folks are trickling in to chime into the chat and let us know that you're here. If we know you, great. If not, let us know where you're from. I'm noticing that the percentage of repeat visitors here has been quite high the last few webinars. Suppose it suggests that we're doing something right, that the presentations are valuable. Josh Barker, how's it going? Glad to see you here. Also, more and more, I feel like people resurfacing who I talked to in November 2021 and haven't heard from since. But always good to see.
I remember that I can precisely remember when I joined Valur Attack. I was on a call with Mani, and then they resurfaced after kind of 2 years, and thinking they're going to pull the trigger on whatever product that they are interested in at that particular time. And then it's been a cross sell as well. Someone came for charitable remainder trust, got interested in ordinary, and it's
and read the 900,000 words that we've written on these subjects literally, and got interested in something else. What time is it? It's 2:02 Eastern, 2:02 and a half. Let's get started. We've got good numbers already, and people can roll in over the next few minutes, and probably won't miss a ton. Welcome everybody. You've got me, Jeff, and Farhan again, a pairing that's been repeated over the months here. We're talking today about oil. We're going to do a little bit of history and policy and talk about why there's a boom in American oil right now. I think a lot of folks probably know the answer to that. And then we'll really focus, of course, unsurprisingly, on investing in oil and gas funds and the tax benefits and investment benefits that doing so brings. And of course, we'll leave some time for Q&A at the end, but everybody should chime in really whenever they feel like it. I won't belabor this point. Again, most of you know who we are. I'm Jeff, part of the founding team at Valur. I run product and partnerships and do some help on the tax operations side. These presentations, I'm all over the place. And with me, I have Farhan, who is our head of ordinary income planning, the person you probably will speak to the most if you're pursuing these things, at least in the kind of ideation stage. So we are the ones at Valur who can talk about this stuff, and that's why we're here. As I started to preview, definitely going to do a couple of minutes on history, the recent history of American oil, and talk about why there's a boom right now, and at a high level what that means for the availability of tax-advantaged oil investments, a little bit about what that means for the returns from these investments, although we'll touch on that more later in the presentation. We'll then dig into the meat of this, which is tax benefits. These are tax-first vehicles. That's why Valur is talking about them, right? What we do is we help you all reduce the tax that you're paying on all kinds of income and estate. And so we're out hunting for opportunities that have a tax component to them. Not entirely tax. These investments that we'll talk about do have a significant investment return as well. But the point of this all and why we got started on it is tax, and we'll talk about that. We'll talk a little bit about maximizing the tax benefits here without hands-on involvement, or another way to put that is without material participation. I know a lot of you are aware of that requirement in other contexts, whether it's solar or real estate, and we'll talk about why oil maybe is a good fit for folks who can't meet that requirement in other contexts. We'll do a case study, as we always do, a quick look at our calculator on this subject to show you how to use it and what the numbers will look like. And then we'll leave some time for Q&A. I think history shows that for the most part, you all aren't shy about asking questions as we go, and that's great. Definitely chime in the chat. We'll answer questions for the most part as we're running, and then if there's anything left over, we'll touch on those at the end. And then after that Q&A, we'll wrap it up, and we'll maybe circle back to talking a little bit about how Valur fits into all of this, and certainly how we can help you all get started in this area. So Farhan, you want to kind of talk a little bit about history and practice?
Yeah, exactly. Thank you. So the first major piece that I wanted to start with is the technological advancement in the oil and gas industry. Now everyone is seeing the AI boom. Similarly, things have gotten significantly better over the passage of time in the oil space. And the first thing that I want to talk about is the Permian Basin. It's actually, for context, everyone, it's an area with a significant oil and gas reserve, and it covers some part of Delaware, Texas, New Mexico. And the benefit is that as it consists of multiple layer of rocks, where you could drill oil and gas, and it's very productive for big companies like Chevron to drill over there, because it's just the return, compared to relative other areas, it's just significantly better. And that's just one piece of the puzzle. The other thing is that the technology itself, like we have seen from vertical drilling to horizontal drilling, it's called fracking as well, right? Where you can actually go and put some explosives, there are cracks, and exactly it's one of the best method that I can think of right now that the companies are using to extract and get the more thing out of it. In early 20s, the probability of you drilling, and it's not 100% in today's world as well, but the probability of you drilling and finding an oil was around 40. And right now it's 80%. It's still not 100, but it has gotten significantly better. So if someone, a fund who's drilling oil and they're doing operation based on a single well, there's a probability that they may not find it. So a diverse solution is helpful. Sorry, go ahead.
No. I was just gonna amplify that. The idea here is that, and we'll get to this in talking about these particular funds and investments, but the idea is that your returns from investing in oil and gas are going to come from two places. They're going to come from tax savings, and they're going to come from the production and sale of the underlying commodity. And so what we're talking about here is essentially why you should be comfortable, if you decide to do this, why one might be comfortable with this as an investment. And to your point, Farhan, this is a trajectory thing. These funds were profitable and had a solid return over the last 25 years, even before these advancements in technology, in drilling technology. Now that fracking has become certainly more widespread, and also I think candidly more politically acceptable, right? You remember in the 2010s, there was a moment where fracking was a target of some environmental politicization. And whatever you think about that, we don't do politics here. Whatever you think about the political side, fracking is a very efficient technology. And to Farhan's point, these wells are now much more likely to produce oil or gas, which means that although your investment is in a diversified portfolio of wells, the more of them that produce the commodity, the better for the overall returns. So Farhan, before I turn to policy and 2025, anything else you want to add on technology and?
No, I think you've covered it all, because at the end of the day, it all boils down to how efficient the funds are and how things have been improved over the passage of time, because that's what people look for, right? At the end of the day, we want to make sure that they're performing better and they're giving us the better ROI, right? And no one will come back to that, but no one is going to put it into writing how much you're going to make, because it's a commodity and it's highly volatile. But given that's technology has significantly has gotten better with the passage of time, and there's just a lot of advancement. It gives you some level of certainty knowing that there are better odds now compared to where we were, right in early 20s.
That's right. And to build on top of that technological development and the idea that the American geography, the Permian Basin down in the South and Southwest is a really profitable place to drill. You add on top of that in the current political and policy moment, there is renewed attention to increasing American oil production and gas production. We have some notes here. The current administration in 2025 has significantly reduced the permitting process, the environmental and local permitting process, reduced the fees that one has to pay in order to get a permit and then to build an oil well. There are several other policy developments, but the idea here is that the administration is committed to increasing oil production, and therefore, and in order to do that, is making it cheaper, less time consuming to do so. And so that explains a big part of why, combining with the technology, why even though drilling was profitable in 2015 and 2020, why in 2025 we're seeing a significant uptick in new drilling and overall production. And so, that really is all just atmospherics, right? The ultimately the numbers are the numbers, but we're going to talk about on the non-tax side, but the investment side, what these numbers look like and what you can expect or what you should expect. And, those numbers will be bigger now than they were 5 years ago for all of these reasons. Farhan, did you want to say?
Yeah, so I was just going to say one line about it, and that is that the policy drives a lot of these things, right? Looking at the Inflation Reduction Act, which is driving the renewable energy space, right? And then looking at this, so the current administration, which seems very favorable towards oil and gas, is going to drive a lot of the market, right, in the upcoming years. And considering the fund's target first couple of years for the cash flow and people getting their money back, I think it's going to be interesting to see, and the wind seems to be favorable towards the space. So,
yeah, that's right. So with the kind of background and policy out of the way, I think it's the next step is to talk about what do you get out of this, and just to step back. I know most of you know this, but just to make sure that we're all on the same page, the idea here and what Valur supports on, and what you all, I think, are here to hear about is what are the benefits, what are the returns to, and certainly the costs and the drawbacks as well, which we'll talk about. But why, what is this and why are we doing it? And so the idea here, which we've already previewed, and I know a lot of you have heard about before, the idea here is that you are buying a share of or investing in a fund. And that fund is run by a firm, a partner of Valur or a Valur Finance. That fund then, the capital in that fund is then deployed to go out and build oil and gas wells in the geographies that Farhan described. And what you're getting out of that, your investment in that fund, is a few different things. There's a tax side, which Farhan will talk about, and then there's an investment return. And so this slide breaks down those two things, Farhan.
Yeah. So there, as Jeff mentioned, their return is going to come in two forms. So there is tax savings component to it, and there is an income stream component to it. Tax savings component. So if you put $1 inside this fund, you're looking at around 92 to 94 cents in depreciation deduction in year one on federal level. $1 in, and you're looking at 92 to 94 cents in depreciation deduction year one against your federal income. Now, not all the states accept IDCs, so you may want to look up for the state, but the states like New Jersey, New York do accept. States like California do not give out those 94 cents in year one. So you'd have to look in the state, but on the federal level, you're still looking at 92 to 94 cents. That being said, this is the depreciation piece of it. In year one, there is going to be additional depreciation of 13, 14 cents that's going to come from year 2 through 6. But the major chunk of it, right, is coming in year one, 92 to 94 cents, which is very important, and I'll connect the dots. Now, that is just the depreciation piece of it. right? You don't have to set up any entity. You don't have to do any hours. We'll spend more times on it. But just so you know, without doing anything, just writing in a check, you are able to deduct 92 to 94 cents.
And maybe we can just do a quick double click on the idea of depreciation. I know we've done this over and over again in the context of solar and oil and gas, and most of the folks on the call here are going to know right off the top of their head what this is about. But just to make sure, the idea here is that there's a deduction from your taxable income associated with your investment here. So if you invest $1 in one of these funds, you're getting, as Farhan said, around a 90% or 95% deduction, which means that for every dollar you put in, you get to remove, let's say, 90 cents from your taxable income. So if you put $100,000 in, you can remove $90,000 from your taxable income. And that then, of course, yields a tax savings. If you reduce your income from $500,000 to $410,000, well, you're going to owe less tax. You're going to multiply that difference times the marginal rate you would have paid, and that'll save you, money on your taxes. So that's the idea on that side.
Exactly. Helpful explanation, Dev. So that's, depreciation, one part of things. The other part is the income stream that people are very curious about. So, taking it a step back here, coming towards the Jeff point. So you're putting money in a fund, and fund takes that money and, drill oil and gas. So there is a depreciation piece of it. That's what you're getting out of it, right? As a tax savings. And the second piece of his income stream, they're going to drill on oil and gas. They're going to sell it in the market. They're going to make money. So what is the cash flow is, right? What should we expect from it? Now, for compliance reasons, because, as discussed, that oil and gas is a highly volatile commodity. No one can put it into writing that exactly how much you're going to make. No one's going to say that you're going to make 30% every year, cash on cash return, fixed, flat, not a high risk. Can't do that, right? It's a volatile commodity. No one predicted COVID. It came, the oil prices went negative, right? People were just paying to get it out of their hand because there was a storage cost. So the income stream of it, however, we rely on historical numbers, right? What has been, and few years back we're in COVID, and the prices were just literally negative. So we rely on those historical numbers to see how it has been operating and whether it's been profitable or not. And what we have seen is people have been able to get their money out of it. And when we say money out of it, we're saying cash on cash return, not taking depreciation into consideration. So excluding depreciation, people have been able to get their principal out of it over the course of 4 to 5 years. First couple of years have been very aggressive historically, and the reason for that is this is just there is a limited quantity in the world, right? Even there are hundreds of them diversified. We'll talk about it, but they extract the majority of it in first couple of years. You have the optionality, right? It's the best way to do it. So they extract majority amount of in first couple of years, and that's where we have seen people able to get their money out of it. But that doesn't mean the cash flow only lasts for 4 or 5 years. The cash flow can go on either for the useful life of the equipment, which can be 15, 20 years plus, or as long as drilling is economical. And that's a point that I want to spend a minute on. And when I say as long as drilling is economical, because there is a cost that goes into drilling, right? There's chemical, labor, equipment, and all that. Suppose in year 16, the quantity isn't enough, right? It's very low and the price in the market is very low. It doesn't make sense for them to drill anymore. But, pointing it back to the cash flow, the first couple of years are aggressive. We have seen people making their money back over the course of 4 to 5 years. And over the length of it, we've seen people making 200% cash on cash return. I was looking at the cash flows for people who invested in COVID, and they're positive. It was last year around 110, 120%, if I remember it precisely. And that's historically where the prices have been lower, right? Literally negative. So I'm not sure we're in COVID right now. The situation is significantly better, right, in terms of oil prices. But
yeah, for a lot of reasons, the prices, the technology that you described, for a lot of reasons, one might expect, and this is something that if someone's going to decide to invest in this, of course, you'll have to do your own diligence and make a decision as to how you're going to underwrite this and what numbers you're going to expect. But we have reason to think that the numbers are going to be higher going forward for the reasons we've described, and even in the last 5 years before those changes, things were rapidly turning positive.
Another aspect, and that is related to income stream, is the preferred return, right? So when you put money in a fund, right, the fund managers have carry on these things, right? They make certain percentage of the profit. So if you put $10 inside the fund, right, they'll have a 20% carry, which means if they make, suppose dollar on your investment, 20 cents are going to go to them, 80 cents are, going to go to the client. Now there is a carry, right? They're gonna make their fee, but the fund managers give out a preferred return. What essentially a preferred return is that if there is a cash flow, if there is a profit generated by the fund, who'll have the preference over this? Who's gonna get it first? Who's the first in the line? And the fund managers, right? And we'll point it back to the cash flow, but the fund managers give out up to 100% preferred return if you invest till July, which means if there is going to be a cash flow made by your investment, if there's going to be profit, you will get 100% of it back first. You'll be the first in the line to claim it before them. And the reason I think it's a very important point, because then, right, they're not going to make anything unless you get all your money back. So their incentive lies that you make all your money back, because after that, that's where they're going to make their money. So they would be thinking about getting your principal, right? 100% cash on cash return, not taking depreciation into consideration, and then, drilling more so they can get something out of it. And that's how we see the objectives are aligned, not in a way that, they're drilling it, they don't care about it, all those things. So I think that's one major aspect of it. And the last thing is the passive involvement, right? In all those things that we look at, solar and real estate and other structures as well, that it requires you to set up any entity, it requires an extensive amount of paperwork, and then moving forward, involvement in these things, right? It doesn't require you to go visit the drilling pad. It doesn't require you to set up any entity. It doesn't require you. And that's, in a sense, that's one side of things. That's the work, right? The time you're going to save, the overhead. The other thing is that, you become a limited partner. You don't have any liability, right? You wire a check in year one, your GP, but moving forward for the rest of the life of the fund, you stay an LP, you stay a limited partner, not to have to worry about the work that you're going to put in, the hours that you're going to put in, and the liability of things moving forward. Jeff, you're on mute if you're saying something.
I'm on mute. We have this under benefits. I think it's really important to kind of understand where this comes from. As Farhan said, the idea here is really defining this in contrast to other things that you could do to both reduce your tax and get an investment return. We'll talk about this in a few minutes, but comparing this to solar and to real estate is really the point of that last column. Most investments are passive. In the tax world, most of the things that you can do to reduce your tax require active participation, and this doesn't, and that's a significant benefit. So to step back and level set, we're talking about significant tax savings. We're talking about a significant income stream, much of which is a preferred return, and you get all of that without having to lift a finger, which is maybe the biggest distinction from some of the other things that Valur does and offers. So this is the next slide. I guess we could have just seamlessly gone on. The idea, as Farhan previewed, is in contrast to the other sorts of tax advantage investments and purchases that we talk about. The one that you've all heard us talk about is solar. This is also true of real estate. In general, this is a general feature. I know a lot of you have heard me say this before. This is a general feature of the U.S. tax code, that the character of the tax benefits that you're getting from a particular project or investment or purchase have to match the character of the income that you're using those benefits to write off. And so, as a good example that a lot of people are familiar with, in real estate, if you own a rental and that rental income is passive, you're not an active real estate professional, then the depreciation that you get from that rental property can only be used to reduce your rental income, your passive income. Whereas if you become an active material participant in that project, if you become what's called a real estate professional, by spending 750 or more hours a year, well, then you converted that depreciation to active, and you can use it against your active income, like your W-2, for example. Similarly, in solar, which we talk about a lot, if you want to use the solar benefits, the depreciation deductions, the investment tax credits against your W-2, your RSUs, even your business income, well, you have to convert those benefits to active. And to do that, you need to spend 100 hours or more per year in the solar business. The major difference here is that with oil and gas investments via these funds, there is no such requirement. You don't need to spend any time because you can use this to offset active income simply as a result of the way this is arranged legally. There's way more to talk about there. I think that's probably a subject that's better reserved for a conversation if you're interested in pursuing this. But in general, the idea is that the form of partnership that this is and the status that you have in the first year is allows you to use these depreciation deductions against your W-2 income or your business income, even without actively participating, spending hours in the project. Farhan, is that a fair kind of summary?
Yeah, exactly. I think at the end of the day that, a material participation requirement, it's hours that people would have to put in, and this is something that they would have to take into consideration before pulling a trigger and, whatever real estate.
That's right. And that's a helpful reminder. I do want to step back and talk about really what this means practically for you and your clients when you're deciding which of these many options to pursue. We do a lot of solar projects at Valur. Many of you who are on the call right now and your clients. We help people get into tens or hundreds of millions of dollars of solar projects a year. Those projects require material participation of 100 hours or more. And our clients, you all, are very happy to do that because the benefits are so large. That is absolutely a valid approach and position. The point here is that there's an alternative. And once in a while, it's not common, but once in a while, we'll talk to someone who doesn't want to spend that time or can't spend that time. Either they're too busy or they don't think the trade-off of the 100 hours for the benefits is worth it. And for that group, oil and gas can be a natural place to turn because you're getting, while not quite as large tax benefits and returns, you're still getting significant tax savings and returns. And without the 100-hour requirement, that can be an attractive proposition for a lot of folks. So that's the idea. That's not to say that the 100 hours is prohibitive on the solar side. We have plenty of clients who choose to do it. But if it's not a fit for whatever reason, it's a nice feature that you can turn to oil and gas and do this without spending that.
And, this is very helpful. One thing to add here is that, for several, for some reasons, you are just late in the year. You didn't think about solar, right? And now you're in Q4, right? And now you're looking at a big tax bill and you want to do something about it. And solar, there is a high possibility that the solar may not be an option for you at that point of time, right? Mechanical completion, deal participation, all those reasons. But an oil and gas is there, right? It's open till the end of the year. And it's helpful to know that, you don't have that material participation requirement.
That's right. You can do this. You can do this on December 30th. We don't recommend it. You should definitely, since you're here, you're talking to us. That means you're on top of this. You should definitely get started on this before then. But we helped clients get into oil and gas on December 30th of last year. I don't know about December 31st, Farhan. I don't think anyone knew came in on December 31st. Strongly, recommend against that. But the point is, if it's December or even November, and solar is out of the picture, or other, buying a rental property, or whatever else you want to do, it's helpful to know that oil and gas is here and that there's no time commitment that's going to make it impossible to pursue. That's a good point. With that being said, there are for sure some risks associated with these sorts of investments, as with any, and so it's important to talk about these. Farhan.
So in terms of risk, I think that the pointing them back to the same thing. So two major benefits. So there is a tax savings piece of it, and there is cash flow piece of it, and that's how the risks are divided between two phases. So there's one that is general partner liability. So in order for you to take that depreciation against your active income, you have to have a status of general partner. That status doesn't require you to put any hours in, doesn't require you to go and operate the fund, nothing like that, but you still have the status. The IRS is not going to let you take the depreciation against your active income. You have to have that GP status. Now, that GP status, general partner status, is going to be for the year you're making the investment. So if you're going to do it in 25, you'll be general partner in 25. But from 26, you become an LP, limited partner, right? No liability, nothing, passive involvement. But for that current calendar year, you have to be GP, right? So that means the distinction between JP and LP, the major thing on your end that you have to be concerned about is the liability end of things, right? You are actually putting yourself on a hook for liability, right? And you sort of have that exposure, right? So it's a sort of a risk. How that risk is mitigated is the funds carry a liability insurance, right? These are very big funds, mid 9 figures, right? So it's they have to have that, and they carry a liability insurance of around $100 million, between 150 and $100 million, which is pretty big, right? To cover if there is any issues down the road as well. And along with that, right, there is no drilling in that particular year, because liability issues can occur when there is an actual operations that are happening, but that's not the case, right? The fund stays open, you put the money in, they close it at December 31st. That's one way to mitigate it, but it's not that not operating it and not having there is on the back end, there is a liability insurance.
Okay.
If that were
and for both of those reasons, we'll never promise anything. I'm a lawyer, as many of you know. I'm never going to speak in categoricals, but it's worth pointing out that, and Valur's only been doing this for a short time, but our partners have been doing this for decades, and it's important to note that we are aware of no case where an investor like you all ended up with actual liability as a general partner. It just doesn't happen in practice. It's something you have to think about and diligence and absolutely get comfortable with. But the structural protections that Farhan described are, if not absolute, then certainly quite protective.
Exactly. And sorry. So yeah, the second piece is related to the income stream of it, like and pointing it back to, it's a volatile commodity, right? So there's two ends of it. There is the production piece of it, right? How you are extracting it, how much you are extracting it, and the other piece of it is the price in the market that I don't think no one can dictate where it's going to go and all that. Now, in terms of the production piece of it, right? I think it would be helpful for everyone to know that this is not the fund that Valur Finance is a partnership with. It's not a one well that they drill, right? They're not betting against the odds that they may find it, they may not find it, even though it's high. You cannot put 9 figures in a single well. So it's hundreds of them, and it's diversified. So if you're drilling, 300 wells, there is, with the current probability, you're definitely going to find oil, right? And depending on, even if, I'm taking rough numbers, but let's just say half of them, right? 150, 200 of them. So there's definitely going to be oil, right? The price in the market would dictate how much is it worth, right? No one, again, for compliance reasons, can put it into writing that's going to be worth that much and all those things, but there's definitely going to be oil. And it's a good thing to have something that's diversified, right? You're not betting against the one fund where there's one well, and there's, after a year, they'll come back to you and with, empty hands, and they'll say, well, we've tried our best, but there wasn't anything. Have a nice day. Let's meet next year. So it's good to have it, a diversified structure where your money has been over hundreds of all. And the second thing is the price in the market, right? But when you are running at a 9 figures worth of a fund, there are certain guardrails that you put in place to make sure, right, that the price doesn't hit a certain level, right? So you buy future contracts and swap, and the information is going to be available in the BPM, and we'll share it with people. But there are guardrails in place, but still, like I said, for compliance reasons, no one's going to promise. So to sum up everything, one is the general liability piece of it, right? You have certain exposure, but that's covered by the By the liability insurance not drilling in year one. And the second piece is particularly about the revenue, the income stream. And no one is going to put it into writing. No one can promise anything. But the way they are mitigating it as of now, as we have looked into, is it's diversified over hundreds of all. So there's definitely going to be production. The price, obviously, we can't, it's a volatile asset, but the fund buys these swaps, future contracts, to make sure that it doesn't hit a certain level where they get a hit. Because pointing it back to the preferred return, that their incentive lies that you making most of your money or all your money back, so they can make some money. And I think that would be helpful.
Yeah, that's right. That's right. It's a combination of derivative protections, of insurance, of improved technology, of the policy environment. All of this, suggests that revenue will hold up and may even outperform what it's looked like over the last 20 years. But that's always something that you need to evaluate yourself for sure. So just a couple more points here. We've got about 10 minutes left. We wanted to kind of sum this up and talk about how this actually works. Really importantly here, as many of you know from working with us on this, on oil and gas, Valur doesn't offer oil and gas. There are regulatory reasons why oil and gas is offered through our sister company, Valur Finance. And so I'm going to give you a little preview of that process in a second, but not go too deep into that. It's something that we can definitely talk with you individually about if you or a client wants to get involved. But at a high level, the idea here is that we, Valur, and then eventually Valur Finance, help by qualifying you or your clients, by figuring out if this is going to be something that's going to save you money. And as we put here, in general, if your income is over about $300,000 and you're an accredited investor, you're going to qualify. It's not for everybody, for sure, even at that level, but that's where the numbers tend to point in the right direction. Our Valur Finance's systems will help you understand the optimal size, or rather the biggest project investment that you can justify given your income. So if you make $1 million, it's going to tell you that, well, a $400,000 or so investment is probably what's going to yield the maximum tax benefits. Once you have that information, it's up to you to review the available information, pro formas, models, documentation, and then invest. After that, there's really not much there. You get that upfront deduction, which you get via a K-1, and it goes on to your personal tax return. There's no special entity here. And then that income comes in every year after year one. Yeah, go ahead.
Sorry. Yeah. One thing that I wanted to add here is that the process is the same as Jeff has described. It's just that one piece here is the accredited investor verification. So the requirement here for people to know that they have to be an accredited investor. So either their net worth has to be above $1 million, or if they're married filing jointly, their last year's earned income has to be above 300,000, and that's an important requirement. And there is a third-party verification that you have to perform in the process. Get a document from them that says that we certify that you are an accredited investor. You take that, give to the fund. The process is relatively simple. It takes literally 2-3 hours to get that done, but it's good to know that it's a part of the process. You have to be an accredited investor. Once you have that information, it's simple as that. You give out the documents and you move forward.
That's right. And that, I think, does take us to the last point here. As I said, Farhan and I are not directly affiliated with Valur Finance for reasons that I'm happy to talk to you about if you're interested. But I do want to show you this, and this is something that all of our clients will eventually, who want to pursue this, will eventually head to. This is app.valurfinance.com. And this is a place where we can show you a little bit of a case study and also give you a sense of what that process would look like. So anyone who decides to pursue this is going to head over to that Valur Finance site, enter some information, and I'll just click through this really quickly. Let's put in a name. You'll verify that you're an accredited investor, as Farhan said. You'll check a box, but that'll then involve an additional step as well. We ask for some information about your net worth, your income. I'll click through here, and let's imagine for this little just quick case study, let's imagine someone with a $5 million net worth. They've got W-2 income in the range of $1 million. And let's see what this heads to. Put in your address, and this is going to yield. So then it's going to ask you for your risk tolerance, your filing status, and your growth rate, and it's going to suggest the amount of investment that is going to yield the optimal tax benefit given your risk appetite. What you're going to get down below here is a projection of the potential returns. And so here, given that income, given the growth rate, let's put something more like a historical 8%, and given the proposed investment size, down here you're going to see a summary of the potential returns. This suggests that given these numbers, this particular client would see $1.35 million after taxes over 20 years with an oil and gas investment versus about $1.05 million after taxes without an oil and gas investment. We also include here a detailed returns table. Farhan, do you maybe want to talk through this table a little bit?
Exactly. So in the detailed return, what you're looking at two aspects, as we talked about. So it's depreciation tax savings and the estimated oil income. So the depreciation tax savings in year one, you're looking at, again, you're putting in $1, you're looking at 92-94 cents in depreciation. We applied your tax rate to get to the savings amount, so you don't have to do that. And the remaining, the 13-14 cents that I talked about is coming from year two. So you can actually see the actual schedule here, how they're coming through, and you can plan things accordingly. And then on the other end, you're looking at estimated oil income. Now you're maybe surprised looking at 2025, there is no cash flow, right? And that's where the point comes in. There is no drilling in 25. It's just the fund is open. It closes on December 31st. And then, they take everything, issue K1 for the last year, and then they start tracking drilling. So it takes time to identify wells and all those things. So it's not going to be from day one, January 1st, but the cash flow is going to arrive in 26. Now, first couple of years, these are cash flow numbers based on historical returns, right? This is not something definitive, right? This is based on what we have looked at the historical returns, and we have a slightly conservative approach when it comes to these things. So the numbers may be, slightly aggressive if you go to another source and look at them, but we just tend to have this slightly conservative approach. In year one, in 26, you're looking at a slightly lower cash flow compared to year two. And the reason for that is the cash flow doesn't start from January 1st. It takes time. So suppose if they start drilling in, May, June, your first year, it's a quarterly distribution. So they don't have the full year cycle and the first couple of years. So it's lower in 26, and it's because they started drilling later in the year. But then you're looking at 156,000, 176,000. And, if you sum them up, you're looking at a capital return over the course of 4 to 5 years. And then it goes on. You see the cash flow goes down starting, and it's because we are assuming that they extract majority amount of oil and gas in the first couple of years. And then it started to go down because of the low quantity and the price.
And that also, Farhan, just importantly, this is not just something that we conjured up out of thin air. This is based on the actual historical returns from the funds that we work with, right?
Exactly. These are historical returns, but the trend of year two is, it takes time to start drilling, so it's not very, we're not starting on day one, January 1st.
Yep. That's right. Josh asked about operating assumptions. This is a good question. Josh, I don't think we have time to go into this detail right here. There are materials that we can share that will absolutely cover these assumptions among many other inputs. Certainly, you could just shoot us an email and ask for that. But also, if you and for the rest of you, if any of your clients pursue this, that's something that we share early in the process, and you'll be able to vet all of those assumptions for sure. So let me just turn back to the slides here. I think that's it. We did that case study. Yeah. So I think we've weaved in here a lot. There's the idea around the tax savings here. There's the idea of the return and how you might be able to project that, and the environment that produces the numbers that we use. Give you a little taste of what the process looks like getting started. Anytime you want to, you can absolutely go to app.valurfinance.com. I'll just put that in the chat. do I have a banner? No, I'm gonna create a banner. app.valurfinance.com. You can always go here and get started on that questionnaire and get into oil and gas really whenever you want. It's a very quick process. But if you prefer, and for most people this does make sense, schedule a call. Just go onto the main Valur site and schedule a call. You'll have a chance to indicate that you're interested in ordinary income planning, which is what this is typically for. You'll get matched with one of our colleagues, or probably one of the two of us, and you'll have a chance to ask all the questions you have, go through a personalized model, and then eventually get on to reviewing those materials that I mentioned. So that's all available. Don't hesitate to do that. We always love having those calls with you all. If you want to learn more, you can go to learn.valur.com and type in oil at the top in the search bar, and you'll get all of the writing we've done on this subject. Farhan and I are available to discuss via email. And we're here, and this is part of our standard process. Many of you have spoken to us about other subjects, so you know how this goes. We make time to speak with you, typically for about half an hour. We get you to understanding how these things work, and to a point where you can make a decision, or your clients can make a decision as to whether it's worth pursuing further. So don't hesitate to do that. Get in touch. And since we're a minute over, I'll just mention that our next webinar in the series, which is number 29 in the series, very surprisingly to me, is a very different topic. We're going to be talking about asset allocation, and specifically allocation among tax-advantaged entities for high net worth families. So talking about essentially estate tax and asset protection planning, and where you want to put your assets and what assets you want to own. So that'll be our colleagues Peter and Mani, as well as an advisor who's going to be joining us from UBS, I believe, to discuss that subject. So we'll look forward to seeing many of you there, and hearing from you by email and on the site. So thanks for taking the time. We'll talk to you soon.